G'day everyone, welcome to this roundup of global markets for the 26th of October. And what an extraordinary rebound it was. It was like the correction that we had for the best part of 10 days just didn't even occur. So strongly did markets rebound. And it just really goes to show that some of the fundamental drivers that triggered that correction, which really wasn't based on fundamentals, as soon as the American reporting season started and people could see what the results were like, everything just got back to normal very quickly. So let's have a quick run through of what happened in the last week, which really was quite amazing. The S&P rebounded an astounding 77 points on the week. That's 700 points on the Dow as an equivalent. As I said over the last couple of weeks, the decline in America was not warranted based on fundamental earnings growth and also on valuations. It was driven by fear over Europe. It was driven by fear over the Ebola scare, and it really wasn't based on anything of any great substance. And the reporting season that we're now well and truly into is basically proving that. We're getting results coming through and highlighting just how strong the American reporting season is, with quite a significant majority, higher than normal, exceeding analyst expectations. So it's all going along very, very nicely. So it was about people becoming unduly fearful, and also some computer program selling really kicking in as well. And I just fear that unless the regulators really take some steps to rein in this high frequency trading, that we're going to have another event that's just going to get out of control, because I think a lot of the selling over the previous couple of weeks was driven by computers and wasn't being initiated by human beings. So I think it's something the regulators really need to take a look at. Now, the European indices, the German DAX is still in phase 4 decline. Obviously, it rebounded from grossly oversold, but for me, the phase 4 decline is established now. So these markets, whilst they rebounded quite strongly last week, they're definitely not out of the woods yet. And there's no reason why the American market can't continue along and have the European indices going in the opposite direction. The FTSE also confirmed into phase 4, and I see no reason to change that view because the pattern is exactly the same as the DAX index. We'll look at all these charts in just a minute. Turning to the Aussie stocks, the Aussie index ASX 200, which I think is, it's pretty meaningless. It's only representing a handful of stocks. It gained 141 points on the week, and that was pretty much all in the banks. There really wasn't much else going on last week. And the valuations in the banks are just not sustainable. They're only remotely sustainable because of incredibly low yields overseas. But historically, the banks are at an all-time high at a time when the factors against them being able to continue to grow their earnings and grow their dividends as they have are just mounting up month after month. So I'm a bit concerned that at some stage it's going to be a trigger for a sell-off in our banks, and our index is going to come down quite hard. Let's take a look at some charts to start with. This is the S&P index. So let's pan back. This is the first time in a long time that we've had such an excursion below the 150-day moving average. You've really got to go back to August of 2011 when we had some really nasty market action. And that was why I was pretty cautious on what was going on. So that level of volatility is normally indicative of the end of a phase 2 bull market. Now, the rebound, however, has been incredibly powerful. So it's, we really need to prove that that the bull market is really over in America. We need the index below the 150-day moving average for a period of 4 to 8 weeks. Now, we certainly haven't had that, and we could well go on and form new highs, such as the power of this rebound. But there's two precursors to the end of the bull market. One is a sudden increase in volatility, and we've certainly seen that. And the second one is that you need to spend quite a bit of time below the 150 moving average, and that so far has not played out. So all we can say at this stage is that the American market is is still basically in its phase 2 rally, or could be going into a big sideways consolidation for perhaps a year or even longer. So that's all we can say at this point in time. The Russell 2000 broke support. So from my perspective, into phase 4 decline. It's rebounded back a little bit, but nowhere near as strongly as the S&P. So there's no question that parts of the American market are definitely underperforming. If we look at the NASDAQ index, there's quite a sharp rebound in the NASDAQ as well, and that's normally a bit of a market leader. So we're getting some real conflicting signals. Normally the NASDAQ and the Russell 2000 don't diverge as heavily as they have now. This is a massive divergence, so a bit of a question mark there. Let's look at the German DAX. So again, similar pattern to the Russell 2000. We saw a breakdown below key support. We've rebounded back just above it, but you can see now that the index is spending most of the time below the 150-day moving average. The moving average is now rolled over. So for me, no question, this is in a phase 4 decline, but it could take another 6 months to really get into the major selling part of that decline. The FTSE, exactly the same pattern, broke key support and rallied back just above it. So those European markets are by no means out of the woods, that's for sure. And just for the sake of the exercise, we'll look at the ASX 200. Very powerful rebound, but you can see that moving average is flattened out, and we have been under that moving average now since mid-September, so about 5 weeks now. So I think the Australian market is certainly running out of steam. Turning to commodities, gold was $8 lower for the week, and it's noticeable that the gold stock indices are still underperforming the price of gold. That's not a good sign. We really want to see the stock indices trading better than the price of gold. So I'm still extremely cautious on gold. Silver, of course, has broken support, and if you're of that sort of mind, you might consider some short selling around silver. Copper broke key support, but is still, just as often happens with these sort of breaks of very, very large wedge patterns, it holds around there for weeks and weeks on end. So copper's still just holding on to that support by its fingernails, but not looking strong at all. Crude oil definitely weakening right off. Crude oil down, dipped below 80, managed to close at 81, but I really think supply and demand fundamentals, I've seen forecasts on crude anywhere from $60 to $75, so I think we're going to see lower on crude oil yet, so I would definitely be steering clear of energy stocks for the time being. The fundamentals around the supply and demand around crude oil look very poor at the moment. There's the copper chart. Spot copper did manage to rally back a little bit during the week, so just hanging on to that level. We'll have a look at another copper chart which has got a bit more detail on it. That's the 6-month chart for nickel, and it's really fallen quite sharply during the week. So let's just have a look at a couple of those commodity charts. This is gold on a weekly chart, so still just mucking around within this big phase 1 base, but I'm just a bit concerned that the price action might be pointing to a possible break of this 1190 support, which is not what I expected to see. But you've got to trade what is there, not what you believe should be. I believe gold should be, given the world's financial problems, I believe gold should be in a strong uptrend. The fact is it's not. And if I really had to flick a coin at the moment and decide a direction, we've got a downward pointing wedge pattern on a weekly chart. Not a great sign. We've got the same thing on copper. Let's just have a look at the copper chart. So this is the copper chart on a daily. If you pan back and have a look at this huge big wedge that really started forming about September 2011. So it's been about 3 years in the formation. You can see we've got this flat base here, and we've got lower highs all the way through. This copper chart looks very sick. Now, it could take a few more months. It's been 3 years in the making so far, but the odds strongly favour copper breaking to the downside. Not a particularly good chart, that one. So let's have a look at the overall strategic approach. I really recommend that you stay with the basic formula that's working. That's that you should have the majority of your funds overseas, because that's where the profits are. And also, I believe all the signs are that the Australian dollar will probably track lower over the next 6 to 12 months, which means you're going to get a currency boost as well. So I think it's it's pretty obvious where your activities should be centered. And of course, where do you want to go with those overseas funds? Well, the selected US sectors that are the high growth sectors that are really good value. Members know what those sectors are, know what all the stocks are. We're in them, we're doing very well. If you're not in them, then you really need to reevaluate your strategies. So if anyone would like some more assistance with their trading or investing, there's my email address. Please feel free to get in touch with me, and looking forward to a very good run into the year end now that we've got this bit of a correction out of the way. So that's it for this update. Cheers.